Quarter to 30th of June, Catholic Values Trust returned 7.23% net of fees. The Income Trust 1.94% net. Big turnaround from March, honestly. Once the geopolitical picture started easing, markets surged as the sentiment improved. Here's what happened. There was a ceasefire in early April, and then on 17th of June, the US and Iran signed that memorandum of understanding. Oil dropped more than 30% on the back of it, down to around US $69.50 a barrel, basically back to pre-war levels. And once that inflation risk came out of the market, sentiment recovered fast. Equities had an extremely strong quarter. The ASX 200 was up over 4%, which got the financial year to about 7.4%. Offshore was even better. Our global equities allocation was up over 18%. The US did well, but Japan was the real standout. The Nikkei returned something around 37 or 38% for the quarter, off the back of strong AI-related earnings and a softening in the Japanese yen, which supported export earnings. And locally, 8 REITs were the best performer by far, up 13.7%, helped by falling bond yields and the RBA finally pausing after 3 hikes earlier in the year. For the Catholic Values Trust, that's really the story. Equities rallying hard, both here and offshore, plus a strong rebound in property. For the Income Trust, it was the hybrids that did the heavy lifting, delivering strong coupon income plus further spread tightening. And the fixed interest book benefited too as yields came down. Markets also pared back their interest rate expectations through the quarter. We went from pricing in a decent chance of another hike by year end to now just under a half chance of one more rise. That repricing helped pull bond yields lower. On top of that, as the Iran situation de-escalated, oil prices came off, and that took a lot of the recession risk out of the market's thinking. Less recession risk means credit spreads tighten, and that's exactly what played out. The technicals were strong too. There just wasn't much new bond supply around in June, and coupled with a few larger bond maturities, which was put into secondary markets. The iTraxx index, and that's our credit risk gauge, tightened from around 84 basis points to 68 over the quarter. So overall, rate expectations eased, spreads tightened, yields dropped, and that's what drove the strong result. So where we're positioned at the moment, we're running things still mildly defensive overall. In the Catholic Values Trust, that means we're a little underweight Australian equities. We're still neutral on global equities, and we're modestly overweight in fixed income there to add to our overall portfolio protection. And we're being pretty picky on credit quality now, given how tight spreads have gotten. In the Income Trust, not much has changed this quarter. We're still mainly invested in high quality floating rate bonds, a combination that just keeps the income coming without taking on too much duration risk. In terms of why these two trusts and why now, 1, income. Steady, consistent, and above what you'd get in cash or term deposits. And that's really the Income Trust's whole job and purpose. So 2, values. Both apply the Catholic Values policy, and there's independent oversight from the Catholic Values Advisory Board. And 3, it's how we manage it. This isn't a set and forget. We're actively shifting positioning as things change, which matters a lot right now given how uncertain the investment environment has become. Thank you. We'll catch you next quarter.
Equity Trustees is the responsible entity for the Catholic Values Trust and Income Trust, and neither SG Hiscock and Company, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as an indicator of future performance. You should obtain a copy of the information memorandum before making a decision about whether to invest in this product. Follow the link in the description for the full disclaimer.